Okay, welcome back. For the ratio analysis part, we practice plenty of time for the ratio part. Ratio calculating all this liquidity or productivity, profitability, insolvency, Dupont ratio are exactly the same as what we've done in class. Okay, here the kernel ratio I don't want to calculate at this moment, but the current asset divided by the current liability, you can just exactly put this link on the balance sheet, and then 2019 also the same way. The current asset divided by current liabilities. You can calculate the quick ratios as the cash and the equivalent marketable securities account receivable except for the inventory and other current asset divided by total current liabilities. Okay, calculation, as you can see that you can just exactly put the correct the account on along with this equation, right? Along with this equation. But more importantly, what is that meaning? What is that meaning? For example, current ratio between 2 years has been lowered, right? And that means that the current ratio, the ability to pay short-term liability is getting a little bit worse, right? But when we compare the accounts receivable turnover or days in receivable, it has been really better, right? Because days in receivables is only 21 days, means that the company now has the receivable policy very tight, so that they can increase the cash cycles, right? So likewise, you need to explain. So you also explained with this accounts receivable turnover 17 times. What is the 17 times? Why it has been significantly improved. The company increased the turnover ratio, accounts receivable collection, so that we can reduce this days in receivable. Okay. What about inventory turnover part? Inventory turnover has been improved, right? Improved. Is this because of when you click this? Inventory between 2 years has not been changed a lot. But the total cost of sales, total cost has been increased because, that's because the inventory turnover has been improved. Not because of the inventory decreased, but because of cost of goods sold increased. Likewise, you can interpret. And then the days in inventory along with this inventory turnover has been reduced. So the company has very strong inventory cycle, right? And then asset turnover, and then the fixed asset turnover, you need to explain what does that mean. Mm-hmm. And then in terms of profitability, wow, as you can see that return on equity, when you calculate net income divided by total equity, right? Total equity. Then we found it has been significantly improved. Why it has been significantly improved? You need to explain the why, right? So the total shares it's not because of net income has been significantly improved. The net income has been improved $2 billion. Okay, a little bit, but it's good. But more importantly, the total shareholders' equity has been reduced a lot, right? Because of this common stock and additional paid-in capital. There may be some changes in additional paid-in capital. You need to analyze here by typing additional paid-in capital. You already analyzed on the common stock part, right? On the common stock part. What has been changed? Okay. Then what else? Insolvency part, particularly times interest earned. You can see that operating income, and then you don't see any interest there. So where is the interest? The times interest earned can calculate it by operating income over interest expense. Well, you don't see any interest expense. Where can we find this interest expense? Right, there you go. Cash paid for interest. So $3 billion for the cash paid interest for the year. So we put times interest earned has been improved. That means that the company has been better for the leverage part and insolvency part. Okay? They have a more ability to pay interest out of operating income. And then Dupont ratio explains where this return on equity outcomes came from. Okay, is that from the return on asset, return on sales, or profit margin? Oh, in this case, it's not. It's almost the same. Yes, it's from the asset to equity part. So you need to find where. So likewise, you all need to explain the meaning and the changes in terms of the liquidity or productivity or profitability or insolvency perspective on the Word file. Okay, yeah, that's it. So see you in the next video. Oh, we don't have any other the video clip, but yeah, that's it. That is the Excel part. But more importantly, you must interpret the meaning of each calculations and percentage of the ratios. Okay, see you guys. Bye bye.